Welcome to the deep dive. Today we're jumping straight into RV Group's Q3 2025 earnings, big market reaction, and some really interesting updates to their full year guidance to unpack.
Yeah, what's really striking here isn't just the beat, it's how they're managing, well, very different stories in their main segments. That's what we should probably dig into.
Definitely. Okay, let's get right to those Q3 numbers. They really did beat expectations. Net sales for Q3, an impressive $644.9 million.
Right, $644.9 million. And just for context, that's a solid 20.5% increase compared to last year if you take out the bus manufacturing business they sold.
Ah, good point. Excluding that.
Yeah, and crucially, it didn't just meet analyst forecasts, it sailed past them. Suggests the core business is running, pretty efficiently.
So strong top line. What about the bottom line, profitability?
Also strong. Adjusted net income came in at $38.6 million. That translates to 79 cents per diluted share.
79 cents a share.
Yeah, and here's the kicker for you. That $1.79 wasn't just a little beat. The forecast was around $0.63, so they beat that by, 25.4%.
Wow, okay. That's substantial.
It is, and that operational strength, it pushed Adjusted EBITDA up by a really impressive 66.1% year over year again, looking at continuing operations. That hit $64.1 million.
So profit growing much faster than revenue, that speaks volumes, right?
Exactly. It points towards, better cost control, maybe a better mix of products sold, improved efficiency in manufacturing. Something's clicking there.
Which explains why the stock jumped almost 20% pre-market. That's a huge signal of confidence from investors.
Absolutely. It's likely that combination, the big EPS beat, the strong EBITDA growth. It suggests real fundamental improvement.
More than just revenue.
Yeah, exactly. Plus, as we'll probably get to, they seriously upped their free cash flow guidance. That's always a big positive signal about financial health.
Right, cash flow is key. Okay, so let's break down where this strength is coming from. Starting with specialty vehicles, ambulances, fire trucks, that sort of thing. Sales there were $483.3 million.
Yeah, and this segment is really the powerhouse right now for REV Group. If you, again, exclude the old bus business, sales were up 24.6% year over year. That's an extra $95.4 million.
Almost 25% growth. What's driving that?
It looks pretty clear. More shipments, fire units up 11%, ambulances up 7%, plus a favorable product mix, probably meaning higher value vehicles, and strong pricing. They're getting paid for their products.
So strong demand for essential vehicles, and they're capitalizing on it.
Seems like it. It shows that demand is solid, and also that REV Group has a strong position, allowing them to command good prices.
And that flows through to profits too, right? Adjusted EBITDA for specialty vehicles hit $64.6 million.
Yep, up 71.4%, excluding the bus impact. And look at the margins, 13.4%. That's up 370 basis points or 3.7 percentage points from last year. Quite a jump.
That kind of margin expansion is significant. How are they achieving that and, maybe more importantly, sustaining it?
Well, part of it is strategic investment. They just kicked off a $20 million expansion project for their Spartan Emergency Response Facility. It's in South Dakota.
Okay, what's the goal there?
It's all about capacity. They want to boost fire truck production by about 40%. The big aim is to cut down delivery times, get high-spec trucks out within a year, which is, pretty fast for this market.
Adjusting a key customer need delivery speed.
Exactly. Though, the full impact of that expansion won't really be felt until fiscal 2027, they say.
Makes sense. And what about their current orders, the backlog?
Still massive. Specialty vehicles ended Q3 with a backlog of $4.27 billion. That's like over 2 years of sales based on current rates.
2 years of visibility, that's huge.
It provides incredible stability, lets them plan effectively. The challenge, as you said, is getting those vehicles delivered faster, hence the investment.
So what's the immediate outlook for Q4 in specialty?
They're expecting sort of low single-digit growth compared to Q3, which still means mid-teens growth year over year. But they did flag a potential headwind, about $5 to $7 million related to tariffs.
Ah, okay. So even in the strong segment, external factors pop up.
Always something, yeah.
Right. Let's switch over to recreational vehicles, the RV segment. This picture seems a bit more complicated. Sales were $161.7 million, which is still up 9.7% year over year.
It is, yeah. It's definitely a mixed bag here. They shipped more motorized units, especially Class A and Class C RVs, and got some pricing benefits. But Adjusted EBITDA actually decreased. It was down 13.8% to $8.1 million.
So sales up, profit down. Why the disconnect?
Seems to be mainly two things. Ongoing tariffs on imported luxury vans, probably impacting their Class B models and, interestingly, increased dealer assistance, especially on those Class B models.
Okay, let's unpack dealer assistance. What does that usually signal?
It generally means the market's a bit softer or dealers have higher inventory levels than they'd like. When the manufacturer steps in with more incentives or support, it's usually to help the dealers move units off the lot.
So indicating maybe some consumer caution, perhaps?
Yeah, or just a bit of saturation in certain parts of the market, like maybe those luxury Class B vans hit by tariffs. It points to broader macroeconomic uncertainty affecting discretionary spending, too.
So they're navigating some headwinds there. How does the RV backlog look?
It's down, decreased 7% year over year to $224.3 million. That reflects lower order intake, probably dealers being more cautious, like we said.
Okay. And the outlook for RVs?
Well, the current backlog should support Q4 performance being roughly flat compared to Q3. And for the full year, they actually kept the guidance the same. $650 million in revenue, $35 million in Adjusted EBITDA.
So holding steady despite the pressures.
Yeah, but they're reiterating that those tariffs on the imported Class B vans are still a factor they're dealing with. It really shows the contrast between the segments, doesn't it?
It really does. Okay, let's pull it all together then. The updated full-year guidance for the entire company. This is where they signal their overall confidence, right?
Exactly. Despite the RV headwinds, the overall picture led them to raise guidance pretty significantly across the board. Let's run through the key updates for fiscal 2025.
Go for it.
Okay, net sales raised to $2.4 billion to $2.45 billion. The midpoint there is up about 10% versus fiscal 2024.
Solid growth.
Net income now expected between $95 million and $108 million. That's up for the previous range.
Okay.
Adjusted EBITDA, big jump here, raised to $220 million to $230 million. That midpoint implies a 55% increase over last year.
55% increase in Adjusted EBITDA, that's huge.
It really is. Shows that operational leverage and efficiency focus is paying off company-wide. Then adjusted net income also raised to $127 million to $138 million. And the one that really caught my eye, free cash flow. They dramatically raised this forecast, now expecting $140 million to $150 million.
Wow, compared to what before?
Previously, it was $100 million to $120 million, so a $40 million jump at the low end, $30 million at the high end. Reflects really strong cash generation in Q3.
That is a significant boost to cash flow expectations. What's their overall financial health look like with these numbers?
It looks pretty solid. Net debt is quite manageable, around $54 million, and that includes $36 million of cash they have on hand. Plus, they have plenty of liquidity, about $247 million available under their credit line.
So, flexibility is there.
Definitely. And their priorities for using that cash seem clear. First, reinvesting in the business, like that Spartan expansion we talked about.
Right.
Second, opportunistic share buybacks. They've got authorization for about $142 million left. Shows confidence in the stock price. Third, the dividend they declared $0.06 per share again for Q3.
Returning cash to shareholders.
Yep. And finally, they're keeping an eye out for selective M&A acquisitions if the right opportunity comes along. It's a balanced approach, really.
And that aligns with what the leadership is saying. CEO Mark Skonieczny talked about continued momentum, robust growth, focusing on delivery speed and quality. CFO Amy Campbell seemed confident about hitting targets.
Yeah, the messaging is confident. The biggest challenge, looking ahead, is probably navigating those RV segment issues, the tariffs, the dealer caution, while keeping the momentum going in specialty vehicles.
How critical are things like lean manufacturing, operational improvements in managing that?
Oh, absolutely critical. That consistent focus on efficiency seems to be a major reason for the specialty segment's success. Applying those lessons, adapting strategies for the RV market, even if demand is softer there, that'll be key to hitting these raised targets.
Okay, so wrapping up. RV Group's Q3. Strong results, mainly powered by specialty vehicles. This strength led them to raise their full-year outlook quite significantly, especially on profit and cash flow, even with some challenges in the RV market.
Right. Which leads to maybe a final thought for you to consider.
Yeah.
You see this commitment to investing in capacity where demand is hot, like fire trucks, coupled with really strong cash flow. What is RV Group's strategy navigating these tariffs and market shifts? Tell us about the future outlook for both these essential service markets and the more discretionary RV market.
That's a great question to chew on. Definitely something to think about as we watch how companies like REV Group adapt. Thanks for joining us for the deep dive.